Hello and welcome back to the channel. Stocks are hitting record highs, but the bigger story for anyone watching the housing market is what's happening with mortgage bonds and interest rates. Mortgage bonds are climbing higher again, helped in part by oil prices settling just above $76 a barrel. Lower energy costs are easing some of the pressure that has kept borrowing costs elevated. The 10-year Treasury yield has stayed below 4.71% after testing that level a few times, and the next potential support sits around 4.59%. When these bonds strengthen and yields ease, mortgage rates typically follow. Treasury Secretary Scott Bessent pointed to decelerating rental prices as a key reason he expects underlying inflation to keep moving lower. He described recent inflation spikes as short-term and driven mostly by energy shocks, and he anticipates substantial disinflation through the second half of 2026. Philly Fed President Anna Paulson added a similarly constructive view, saying the current federal funds rate should be enough to bring inflation back to target. She estimates underlying inflation outside of energy, tariffs, and similar temporary factors is already in the 2.4% to 2.8% range. Fresh data from Camden Property Trust supports that view. In the second quarter, new rents fell 3.3%, while renewals rose 2.8%. Blended rents were slightly lower overall, though they remain up 2.8% year over year. That gap leaves clear room for more shelter disinflation, which is one of the most important pieces of the inflation puzzle for the Fed and for mortgage rates. Labor market numbers are also softening. Job openings dropped more than expected, and both hiring and quit rates remain near multi-year lows outside of the pandemic period. Softer job growth can reduce the odds of further rate hikes and open the door for bonds and mortgage rates to continue improving. For home buyers and homeowners, the combination of rebounding mortgage bonds, slowing rent growth, and cooling inflation pressure is constructive. If the upcoming jobs reports continue to show moderation, the path of least resistance for mortgage rates remains lower. That would improve affordability and give more buyers a chance to enter the market. Keep an eye on this week's employment data. It will be one of the next big catalysts for rates and housing.